Have you ever looked at someone with $1 million and thought they must have inherited it, gotten lucky, or started with a lot of money? Most people imagine becoming a millionaire requires a huge salary, a successful business, or winning some financial lottery. But the truth is much less exciting and far more powerful. $1 million is often the result of something incredibly boring. Consistency. The reason most people never become wealthy isn't because they don't make enough money. It's because they underestimate what small amounts of money can become when given enough time. Today we're going to explore one simple question. Can investing just $500 per month really turn into $1,000? The answer is yes, but there's a catch. Actually, there are several catches, and understanding them might completely change how you think about money. Let's begin. Imagine two friends. One starts investing at age 25. The other waits until age 35. Both invest the exact same amount every month. Both choose the exact same investments. Both earn the exact same returns. Yet one of them ends up dramatically wealthier. Why? Because of a force that many people call the eighth wonder of the world: compound growth. Compound growth is what happens when your money starts earning money, and then that new money starts earning money too. It's like planting a tree. At first, growth is slow, almost invisible. Year after year, it feels like nothing is happening. Then eventually, the tree becomes large enough to produce seeds. Those seeds become more trees. Then those trees create even more seeds. The growth starts accelerating. Money works the same way. Let's look at a simple example. Suppose you invest $500 every month. That equals $6,000 per year. After 10 years, you've personally contributed $60,000. Many people would expect their account to be worth around that amount. But if your investments earn a reasonable long-term return, your balance could already be approaching six figures. Not because you saved more, but because your money has been working while you sleep, while you're at school, while you're at work, while you're watching television, while you're on vacation. Your money never clocks out. That's the power of investing. Now let's make it even more interesting. Let's assume you earn an average annual return of around 10%. Historically, broad stock market indexes have delivered returns in that neighborhood over very long periods, although future returns are never guaranteed. With that return rate, investing $500 every month can eventually grow into roughly $1 million. But not in 10 years. Not in 15 years, not even in 20 years. It takes closer to 30 years. And that's the part most people don't like. The mathematics are simple. The waiting is hard. Everyone wants the result. Few people want the timeline. Think about it. Most people have no problem spending 30 years working. They have no problem spending 30 years paying bills. They have no problem spending 30 years making other people rich. Yet when someone says it takes 30 years to become a millionaire through investing, suddenly it sounds too long. But those 30 years are going to pass anyway. The real question is, when those years pass, what will you have to show for them? Let's break down the journey. During the first few years, progress feels painfully slow. You might invest $500 every month after month, year after year. Then you check your account and realize it hasn't exploded in value. This is the stage where most people quit. Not because the strategy doesn't work, because it isn't exciting. Humans are wired to seek immediate rewards. We want results now. We want visible progress now. We want proof now. Investing doesn't work that way. The biggest rewards come much later. In fact, one of the strangest things about wealth building is that the final years often produce more growth than the early decades. Imagine climbing a mountain. The first part is steep and exhausting. You put in massive effort but don't seem much higher. Then eventually you reach a point where every step reveals a larger view. Compound growth works similarly. The early years are dominated by your contributions. The later years are dominated by investment growth. Eventually, your money begins earning more each year than you're contributing. That's when things become interesting. Suppose your portfolio reaches $300,000. A 10% gain would add roughly $30,000 in a year. Remember, you're only contributing $6,000 annually. Your investments are now doing 5 times more work than you are. At $500,000, a 10% gain becomes approximately $50,000. At $700,000, it's around $70,000. At $1,000, it's roughly $100,000. The larger the snowball becomes, the faster it rolls. This is why wealthy investors seem to get richer so quickly. It's not necessarily because they're smarter. It's because they have larger assets producing larger returns. The hardest part is building the snowball. Once it's large enough, momentum takes over. Now let's discuss the biggest mistake people make. They focus on finding the perfect investment. They spend months researching, months comparing stocks, months watching financial videos, months waiting for the perfect moment. Meanwhile, they never actually start. The reality is that consistency usually matters more than perfection. A good investment strategy followed for 30 years often beats a perfect strategy that never gets implemented. Time in the market generally matters more than timing the market. Nobody consistently predicts every crash. Nobody consistently buys every bottom. Nobody consistently sells every top. Even professionals struggle to do that. Instead, successful investors often rely on a much simpler approach. They invest regularly, every month, every year. Regardless of headlines, regardless of fear, regardless of excitement, they let time do the heavy lifting. Now here's something most people overlook. The amount matters, but the habit matters more. Because once someone learns to invest $500 per month, increasing that amount becomes much easier. Maybe they receive a raise. Maybe they start a side hustle. Maybe they reduce unnecessary spending. Maybe they develop higher income skills. That $500 can become $700, then $1,000. Then money $500, and every increase dramatically shortens the path to $1 million. This is why income growth and investing work best together. Investing alone is powerful. Higher earnings alone are powerful. Combining both is transformational. Let's imagine two scenarios. Person A invests $500 monthly for 30 years. Person B invests $1,000 monthly for 30 years. The second person doesn't end with twice as much wealth, because compound growth amplifies the difference. Small improvements create massive long-term outcomes. This principle applies far beyond investing. A small daily workout becomes a healthier body. A few pages per day become dozens of books every year. A small skill learned consistently becomes expertise. Success is usually less about intensity and more about consistency. Money follows the same rule. Now let's address an important reality. The journey won't be smooth. The market will crash. It always does. Headlines will predict disaster. Experts will warn of economic collapse. Friends will panic. Social media will become filled with fear. During those moments, many investors sell. And that's often where the real damage happens, because temporary declines are normal. Market downturns are not evidence that investing has failed. They're part of the process. Historically, markets have experienced recessions, wars, inflation, political uncertainty, and countless crises. Yet over long periods, they have continued to grow. The people who benefit most are usually those who remain invested. Not because they can predict the future, because they understand that temporary volatility is the price paid for long-term returns. Think of it this way. If someone offered you $1 million in exchange for 30 years of patience, would you take the deal? Most people would say yes. Yet when that same opportunity appears through investing, many people walk away because the process feels too slow. The millionaire outcome isn't created by one huge decision. It's created by thousands of small decisions. The decision to invest this month. The decision to invest next month. The decision to keep going when results seem invisible. The decision to stay disciplined during market declines. The decision to think in decades instead of days. Those decisions accumulate, just like the money does. And eventually something remarkable happens. You wake up one day and realize the impossible became possible. Not because you discovered a secret. Not because you got lucky. Not because you found a magical stock. But because you respected time. That's what turning $500 per month into $1,000 is really about. It's not a story about money. It's a story about patience. It's a story about consistency. It's a story about understanding that extraordinary outcomes often come from ordinary actions repeated for an extraordinarily long time. The next month is going to arrive whether you invest or not. The next year is going to arrive whether you invest or not. The next decade is going to arrive whether you invest or not. The question is simple. When those years finally pass, will you have spent them consuming or building? Because the difference between those two choices can be the difference between ending up with thousands of dollars or ending up with $1 million. If you enjoyed this breakdown and want more simple, practical lessons about building wealth, investing, and achieving financial freedom, subscribe to WealthForge. Every week, we break down complex money topics into strategies anyone can understand and apply. And before you go, let me know in the comments. What's the biggest obstacle stopping you from investing consistently right now?